Our next guest is one of the people who began modern derivatives trading back at Bankers Trust in the day. He's the founder and managing principal at Penso Advisors. Ari Bergmann with us now on Money Moves. Ari, thanks for coming in. You're a pioneer. We should have gotten you some Wild Wild West video to go with you in the credit derivatives market. We're talking about tail funds today, tail risk funds. Why does an investor need exposure to these, just in the academic sense?
An investor needs that to provide very high returns, lever returns, at a time when everything else is doing poorly. This way, he'll have, number one, liquidity when he needs, when every investment is faring poorly, so he will have cash to provide for his needs, lower the volatility of the portfolio, and also give him a chance to buy great assets when those opportunities come.
But one of the primary focal points is to protect that investor from market shocks, for example, like we saw here during the credit crisis.
It's exactly right. On a leverage basis, you'll make enough money to at least give you some comfort when everything else is losing.
So what do you see now, Ari? I've seen some statistics, that more and more investors are looking into tail risk funds, which I actually find surprising because the markets, just as far as feel a lot calmer than they did last year.
It is true. There's a lot of demand for such funds. And I think that after 2008, people got the message, and also 2011, that you need protection. Although it appears calm, but the risk premium is there. Options are very, very expensive, and the fear index is very high. People are cautiously bullish.
Cautiously bullish. Okay, now you mentioned, of course, the volatility, and you also mentioned something being expensive. So right now, as far as what's out there in tail risk funds, are investors paying too much? Are they using the tail risk funds in an inefficient way, picking the wrong funds? What's going on?
We see, in our vantage point, we focus on risk 24/7. And we see that risk is extremely mispriced. People are paying up for protection that is ineffective, that doesn't work, too expensive. And because of that, a lot of great protection is mispriced, misunderstood, and is extremely cheap.
What is one of the greater misunderstandings that you think is out there that is being priced in right now unfairly?
Let's say, as an example, on the expensive side, option volatility on the equity side is still expensive. Although the VIX, you look at it, looks very cheap, but that's spot VIX. If you buy longer dated protection, is extremely high because the curve is very, very steep. People are buying out-of-the-money options. So out-of-the-money options is extremely expensive. If you just compare an out-of-the-money put to an out-of-the-money call, if you sell a 10% out-of-the-money call, you can only buy a 30% out-of-the-money put.
Ari, I know one of the things that you're doing at Penso is offering a bespoke product. So what are you building that is better? In other words, where do you think investors who want to manage risk, where should they be focused?
We believe that a commingled product doesn't work. You have to define what do you mean about hedging, what you're expecting about your hedging. The worst thing that you could have is, instead of it's bad enough to be unhedged, it's a lot worse to be mishedged.
So basically you're saying focus on systemic risk.
On systemic risk, and how your portfolio behave, and what are you trying to achieve. Hedging can never eliminate risk. It can only offset risk. So it's important to understand, and it's different for every investor. A hedging strategy is not one size fits all. Each investor is different, and therefore it needs to be bespoke. And therefore, a fund that caters to everybody might, in the end, not cater to anybody.
Ari, we thank you very much. Ari Bergmann joining us there, founder and managing principal at Penso Advisors.